Hi, welcome to the Market Alert for Thursday, the 29th of December 2016. So yesterday, volatility kicked in. We're seeing the market move lower. It tried to head back towards the 20,000 level, which is this red line here. But the best the market could do yesterday, just remove that. The high for yesterday was 19,973, and thereafter we got the sell signal. The market then moved lower by 100 points as it broke through, well, just over 100 points as it broke through the 19,950 level, then through the 19,000, and then headed down towards the 18,850 level, where the market has since found support. And that's what it's done on the overnight. You can see the market there sideways. But it's like history repeating itself, as I warned in the market alert that the market sold off last year after Yellen increased interest rates by 0.25% between Christmas and the New Year. The only difference is this year that the prediction of going to 20,000 and then selling off hasn't happened, and I think that's the 11th straight day, if I recall. I read an article yesterday on Zero Hedge where they said there was 10 days prior to yesterday where the market hadn't actually got to the 20,000. So the question is, will it or won't it? And if we look at the daily chart, we can see that we've got a situation here where the market is struggling to actually do it. There's no major news. We had some selling yesterday, slight increase, prices marked down. We know the market's gone up on fresh air, and we know it's going to give back this move because the volatility indicates that, and I'll come to that in just a moment. So we've got a situation here where the market, if it retraces, let me just throw something into the mix here for you. I'm just going to draw in, this is the high down to the low. If the market can rally back to this point here, where we've got this 62 and 76% retracement, and what I've done is just taken the high down to this low, even though the market's actually just slightly lower here, but of course it's trading live at the moment. I just want to see if it will make any sort of reversal and come back up towards this level. If it fails to come back to this level, then we're heading south, and everything at the moment is pointing in that direction. So let's just throw in a few other bits and pieces here as well. The first downside target is going to be here as well at 19,746, and once the momentum gets going in this, things are going to change quite dramatically. As I've said in many of the market alerts, the Democrats absolutely despise Trump. They despise the fact that he won. Yellen doesn't like him. They are going to do whatever they can to make his life miserable. And I have actually put out a video on YouTube about him being the fall guy, and they're just going to make him look as if it was he that crashed the economy, that turned Obama's so-called recovery into a recession. You name it, you think of it, they're going to do whatever they can. I'm not a Trump supporter. I'm just making these sort of polite observations that we're seeing, and just fitting the pieces together. Don't do politics, not interested. I'm interested in economics because, as I've said before, it's economics that lines people's pockets, not the political aspect of it. And once you know who's in charge of the economic side of things, i.e. central banks now following 2008, it's very easy to work out what their next step is likely to be as well. So once you get the personality conflicts and also the poor loser, sour loser, spitting dummy out of the pram, you just have to see what Obama's doing, what sort of legacies he's trying to actually put in place, legislatively wise, with regards to whatever he's done now, signed off something that's really going to upset the Israelis. You can just see he's trying to leave a ticking time bomb for Trump to actually sort out. And this is the same with the markets. We've had the Trump rally, we've had the Santa rally, the bonuses are sorted, and now it's a case of we can let it go because we're getting closer and closer to Trump being inaugurated. And then once he's in, then, as they say, the proverbial will hit the fan as far as this is concerned. It's whether it can actually rally back first before going into the big sell-off. What have we got today? 4 p.m. crude oil inventories. So this will be an interesting one as well. There's a market that's rigged as well. Has been for a long time. I don't need to go over why, because I've done that dozens of times in the market alerts. You can't believe a single word from the cartel of OPEC and what they're trying to do. We all know why. So that's out at 4 p.m. today. Normally 3:30, but it's out at 4 p.m. For today. And then on the implied volatility, drum roll, here is the latest. I've managed to get this all put together now, and you can see here we've got price bars of the market activity, and then you've got the implied volatility overlaid. So now we can actually see where we get the 100% increase in the volatilities. The market stops and then we head off. We've just had a low at 9.76 a few days ago, and yesterday the market's ticked up now to 10.96. So this way I can, having created these charts, they took a moment or two to do. I can go straight to a 6-month chart as well, and I can see what's actually happening, and I can actually move and highlight more aspects of the implied volatility. So again, you can see there we've had this low, now we're starting to move higher. The levitation is coming to an end. We can see from the low here in August to here is over 100% increase in the implied volatility. This saw the end, and then we saw Trump being elected, and then you can see how the manipulation in the market, just moving prices higher, and then the volatility dropping off. Few peaks moving higher in the implied at this point here. Just add in this one here, and then here, then the market pulling back and making a new low at 9.76, which we had in the last few days. Now you see moving back up to 10.76 as the market's moving lower. There's also an even bigger picture here with a 1-year chart, so you can see where all the last big moves occurred when the implied volatilities were low. You can see there we've got a low, and then we get the market moving down about 1,000 points here, and then we take off again. We've got that new low in place here as well. And then an even bigger picture you can see back 2 years as well. Again, when the market was down in these lows, eventually it gave way. We had a massive correction here, big spike up, and then we came back to the lows. And you can see when we get down to the 12 and 11%, sort of 12 to 10%, you can see the market stops and it then starts to move lower. By overlaying the volatility over the price bars, we can now see this working quite nicely. I'll tidy this up for tomorrow. These are slightly out of place. I didn't realize that until I just clicked on it. So I've transferred it from another computer to this one that I record on. So I will do that so you can actually see how this bigger picture really works when you step back and look, and you'll see how, as I say, when the market gets to the sort of 12 and 10% area in the implied volatility, the market stops and then struggles to move higher there. Also need to just change this so you can actually see it as well. That would be useful. Let me just bring this up. There we are. That's a bit better. So that's it for today. Like I say, it'll be interesting to see how the market reacts to this initial sort of down move. I can't call it a sell-off because it doesn't really sold off. It's a certain weakness that is starting to appear in the market. The question is, will the market get to the 20,000 or not? Who knows? It's a case of they will do their best. It may be that it won't get there, and everybody was hoping for it, and they've been busy selling in the background. So only time will tell as the market unfolds during the next few days. Right, that's it. I will see you in tomorrow's market alert, and as ever, thanks for your support, also for watching. See you in the next.